I'm going to be the moderator today. My name is Carlos Corton. I'm a co-founder and president of Green Tiger Markets. And with me today, John Knorring, who's our CEO, and Oliver Pearson, who's our head of Asia and Pacific. We are going to talk about hedging and about CFDs and tactics to use CFDs to grow your energy business. This is scheduled for an hour. There's a lot of content here, and there may be a lot of questions. So we're going to set kind of a careful cadence, and I encourage everyone to ask questions aggressively. Stop me if something's confusing or not clear, and we'll manage the time into the hour that we have available to us. All right. So today's topic, the power of your hedging using CFDs to grow your business. The GTM Learning Academy is a series of seminars that we've been running over the last few months. We're going to continue to do this. They've been very well received. A lot of clients have been thanking us specifically for doing these types of things, and we see a lot of value in it as well. So, and it gives us an opportunity to connect with our clients. So, thank you all for joining. If you have topics that you want to hear about, drop us a line, and we've got a backlog of things that we want to share. But of course, if there are things top of mind for you, definitely let us know so that we can put it into the Learning Academy backlog. All right, at the end of this session, you're going to understand what is a contract for difference. I'm sure most of you already have a good suspicion. How CFDs can help businesses manage business risk from price volatility, how energy companies improve financial performance using CFDs, how developers can use CFDs to secure financing, and then how combining the Wesum spot market with CFDs together provides an efficient and easy alternative to PSAs. It's a lot. We have a lot of use cases that'll hopefully illuminate the topic. I'm going to start off with just a little bit of a kind of our benchmark slide. We talk about price volatility a lot. The Philippines electricity market has a very high spot price volatility. And one reason that CFDs are so useful and important and relevant to the Philippines is because it's a really great way to mitigate the noise of spot pricing. The ERC recently endorsed the practice of financial contracting and made a specific call out in their 2023 CSP guidelines. And to our knowledge, this is the first time that the ERC has openly endorsed the practice of financial contracting for regulated entities, which is kind of a milestone and a big deal. And of course, it drew our attention right away because we've been working really closely with the ERC and with the DOE to get this practice to become more mainstream in the Philippines. There's a lot of upside to be realized if the industry were to adopt CFDs as a regular practice. And it kind of speaks to this slide. The Philippines right now is in the midst of a really important transition from a physical to a financial market in electricity. And this is a transition that happened in the US in the 90s and in Europe and Australia in the 2000s and more recently in Japan. And globally, the Philippines is actually doing pretty well. A lot of markets around the world continue to be a bilateral physical market, which are dominated by generators that have contracted PSAs. And the Philippines has an active and effective spot market where a spot cleared market decouples generators and consumers and overall improves the reliability of electricity delivery across the grid. The new news is CFDs. And even before GTM came to the Philippines, companies were implementing CFDs as a way to trade on a bilateral basis. But Green Tiger is the first platform to kind of automate the marketplace and standardize CFDs for mass and abundant use. in a very e-commerce kind of a way where it's a click and fulfill, and massively accelerates the contracting process. Really important is that financial energy market decouples the contracting of power from the dispatch of power. And that makes the physical and the financial, kind of splits them apart into separate problems. A consumer or a generator can either buy or deliver energy into or from the grid, and then use CFDs to strike the commercial terms that they want for the electricity that they're pulling or sending to spot. In the balance of this deck, we're really going to dig into the use cases where companies are using CFDs to optimize their operations and their practice. So here's a definitional slide. What is a CFD? It's a financial derivative that is contracted against the published price of an underlying asset. In the case of the Philippines electricity contracts that Green Tiger Markets is running for the Philippines, the underlying asset is the WESM spot price. So for the spot electricity. And the reason that it's useful and important is that any company that has an interest in the future asset, the value of the future asset of spot electricity, for example, it's a real problem that it's hard to know or hard to forecast exactly what that asset's going to be worth, either if they're selling or buying. And CFDs are a really great way to put a hedge in place so that either by holding the asset and holding the analogous hedge, you create financial certainty, and you can lock in well in advance what the business margins are going to be on a transaction. It works both for the long and the short case, and we'll go into those examples over the next few slides. Parties in a CFD transaction, there's a long and there's a short. The long in a CFD buys the CFD and benefits when the asset value goes up. So when electricity goes up, whoever is long the CFD is going to see an appreciation in the value of the CFD. The long is used by consumers of electricity who are naturally short on electricity. So long CFD is short electricity, and then the short on the CFD is actually long electricity. And here's an example, just to kind of bring it home. In this case, I have a steel mill that's long on the CFD and is short future electricity. So in this case, the steel mill wants to lock in the price today for 100 megawatts of electricity from 2025 to 2028. So they're going to buy a 3-year CFD for 100 megawatts. That starts pricing out in 2025. And then in January of that year, they're going to start drawing 100 megawatts from spot. And then they're going to make or receive payments on a monthly basis to true up the spot price, the realized spot price that they're paying against the settled price or the traded price of that CFD. They're going to get paid, in particular, when the price of electricity goes up and they owe more money to spot, the CFD is going to compensate them for the additional costs that they're paying into spot. The story for the short, here I've got a solar farm that is long future electricity and is going to be short on the CFD. And so they want to lock in the price today for 100 megawatts to be delivered from 2025 to 2028. So they're going to sell the 3-year CFD. As that starts pricing out in 2025, they're going to start delivering 100 megawatts to spot and then make and receive monthly payments to true up the received price from spot against their traded price. In particular here, when electricity goes down, the CFD is going to pay them for the lost revenue. So what's happening here is the long and the short are making each other whole against the traded price. So regardless of where spot clears, both parties are going to realize on a net basis the traded price of the CFD. And So this is a picture, and it may take a little bit of study, but here what we're trying to depict in pictures is how net settlement works. So here I've got a CFD. It's a 5-year strip with a long and a short. If you start with the 1-month view on the bottom of the diagram, this is the April net settlement. So when the spot price is below the traded price, the long is going to pay the short. And then when the spot price is over the traded price, the short pays the long. In the month of April, the spot price goes over under the traded price. Green Tiger, as the calculation agent, does all this calculation and figures out what the net settlement is going to be for that month. And then in the upper diagram, you see the 5-month strip. And in each month, there's a settlement. So in January, where prices are relatively high, the short's going to pay the long. Same in February, where February priced up pretty high. And then in the back months where the spot price is weaker, here we got March, April, and May, where the long pays the short. I think really important to call out that it's not as the cash flows aren't really as significant in and of themselves, because very often they're going to net out to small amounts. The most important thing is that the parties have secured continuity and financial certainty in their planning in the context of a high price volatility regime. So even though spot price is wild and unpredictable, the CFD makes it predictable. And that's why it's such an interesting tool for businesses to engage in. Let me pause here if there are any questions. I'm not sure. John, are you monitoring chat? Yeah.
Yes. Yeah. Keeping an eye on the chat. I haven't seen any questions that have come in.
All right.
But yeah, but I think, we'll get to some examples here and perhaps.
And then we'll have questions.
We'll come up.
Yeah. Yeah. All right. So here's a use case. And this is a simpler case. Some of the other ones are a little more complicated, but this is replacement power. So Electra Power, which is a fictional company that we use all the time in our demos, operates a fictional 500 megawatt power plant that runs on natural gas. The plant has a 1-month outage, and we've scheduled it in the fictional month of April. But the portfolio manager of Electra Power realizes that removing 500 megawatts of generation is probably going to cause a little bit of tightness in the spot market, precisely when the company wants to buy replacement energy. And in the industry, in trading circles, is called wrong way risk, where the influence of the power company itself is influencing the price in an undesirable direction. And further, she predicts that if the month is really hot, Electra could be looking at a really high invoice from the spot market for the month of April when the plant is down. So what ends up happening is that this portfolio manager, I didn't give her a name. She buys a bilateral CFD on the online market. And she's going to buy a 100, a 200, and a 50 megawatt CFD, presumably from different counterparties, but it may be the same counterparty. And all the CFDs are in the 5,000 to 5,800 range, which she, in her modeling, says feels like those are good prices. There are also CFDs offered slightly more expensive, but she decides that the remaining 150 megawatts will just be unhedged. So taken together, what she's done is she's designed a 70% hedge against this 500 megawatt outage at a blended price of 51.64. And then fast forward in the month where the plant is actually down, the spot market actually spikes to 7,500. So kudos for her for putting the hedge in place. And she calculates that her strategy saved the company 600 million pesos. Let's see, any questions on the use case? I think this one's pretty straightforward. and probably something that most of our clients are familiar with. John's going to flip over to the platform, and we're going to do a demo on how this portfolio manager would go about finding and placing and trading these CFDs on the Green Tiger platform. So let me stop share and give that to you.
All right. Let me just share here real quick. Okay, so as Carlos pointed out, Electra Power has some maintenance for the month of April. And the plant is a 500 megawatt plant, and so Electra Power wants to hedge. So I've logged into the Green Tiger Markets platform. I've selected Philippines Electricity, and because I'm looking for a monthly around-the-clock contract, I've got the Luzon round-the-clock monthly cash settled selected. So I look over to the April contract, and I can see that there's somebody willing to pay 4,700. There's somebody at 5,000, somebody at 5,100, and somebody at 5,710, and then a 1 megawatt at 6,400. So, you know, if it's, let's just say, early in the month of March, I might want to sort of place a bid, and maybe I can solicit some better offers. So, hey, I'm going to bid 4,800 for, let's just say, 100 megawatts. So I'll go ahead and put that order into the system. And, you know, I'm waiting, I'm seeing, hey, maybe somebody will sell me. Okay, a couple days go by, or my urgency gets to be a little higher. And you know what? These offers are starting to look pretty good to me. So I'm just going to go ahead and buy them. And so I'm going to sweep the order book. I'm going to buy everything all at the same time. So I'll buy the 5,000, or sorry, I'll buy the 100 megawatts at a price of 5,000. I'll buy the 200 at 5,100, and I'll buy the 50 at 5,750, all at the same time. And so when I go and look at my email, I can see, okay, hey, there's a transaction that's been done. So again, this is Luzon around the clock for April 2024. I bought 200 contracts at 5,100 from Macro Power. I'm going to go and see, hey, who else did I get? Okay, hey, I got 50 at 5,750 from Macro Power. Okay, so Macro Power is a decent seller. And okay, here's the 100 that I did at a price of 5,000 with Macro Power. So that's a total of 350. And oh, it looks like the system is still processing the order, but we will see the order book update along with the market activity. I know we actually, some of you may have had a sharp eye there earlier. We added a few products to the test platform. We added both LNG and coal. And so we're already testing those products, but they seem that they have slowed down the platform a little bit. So, but you know, I've already gotten the confirmation, and ultimately that's what matters. So that confirmation confirms what's been done. So it's really that simple. So in terms of placing a bid or just lifting the offer. And I'll turn it back over to you, Carlos.
I think your browser crashed.
I think it did. I've got too much stuff open.
All right, let's go back to the slides. Yeah. That's my.
Oh, and everything just updated. So when we switch back over again, I'll show you all the good stuff.
All right. All right, here's a second use case. This one is a res. And here we designed a scenario for a company called Superb Res, who's going to do some procurement. And so here we've got an energy analyst at Superb Res that has a model that forecasts an increase in demand for electricity in 2026. Then he also independently receives a report that 2 large generation projects widely expected to launch in 26 are going to be delayed. And so he's got this hunch, which is why this light bulb is here, that that 26 is going to be premium. And maybe he's on to something. So in any case, Superb Res plans to add 20 megawatts of new clients each year from 24 to 26. So he has been tasked with securing 20 megawatts in 2025 and 40 megawatts in 2026. So he's going to design a hedging strategy that fits that forecast, his forecast for 26 electricity, and fits the procurement strategy that he's looking to land. So he finds conveniently, he finds a buyer, or he finds and buys a 2-year CFD for 60 megawatts from 2025 to 26. And in my scenario, he chooses to buy all 60 because he thinks that the price at 4,800 for the 2-year strip is actually is quite attractive. So his model says that the 2025, that 4,800 is a fair price for 2025, but a really excellent price for 26. So he's going to buy 60 megawatts of the 2-year strip. He immediately sells back 40 megawatts of the 2025 at flat, and then leaving him flat against his purchasing target for 25. So here you can see his target was 20. He bought 60. He sold 40 back. It leaves him with a net position of 20. So he's long 20 megawatts. On the 2026 position, his target was 40. He's purchased 60 megawatts in 2026. And so he's long 20 megawatts in 2026, but he decides he's going to hold that position because he doesn't think that 2026 is fully appreciated in value in the market. Over the course of 2025, he's going to slowly, gradually unwind that 20 megawatt long position that he's in, and look for buyers at prices that he thinks are closer to the mark. And over the course of 2025, in small lots, he sells that 20 megawatt long position for a blended price of 6,250, which is a good improvement over the 4,800 that he bought them at. So as a result, Superb Res is able to offer its customers exceptional prices at a cost basis of 4,830, despite all the way through 2026, by the way, despite the sharp upturn in spot prices in 2026, which the analyst had predicted in 24. So the dynamics here are pretty good for the res because they can hold their retail prices steady even in the face of higher, much higher spot prices. And then, as a side benefit, Superb Res can also book the 240 million in gains from anticipating the price spike, and then unwinding that long position. I like this use case, or one of the things that I liked about it is we don't tend to think of a res as naturally long because they're consumers and they tend to always want to be buying. And in this case, because of special market insight that the analyst has, he turned the res around and took a long position because he felt that the market wasn't priced correctly, and wanted to really, he's doing a service to the market to actually hold the opinion that 26 electricity is underpriced, and that he's going to overbuy, and then hold and then sell back as a mechanism to correct the general perception of what fair price is for 2026.
Yeah, Carlos, if I can add to this example a little bit, when I was running the natural gas desk at Goldman, oftentimes we would overhedge in anticipation of client demand for natural gas, and it's no different for electricity. I think if you are a res, it's pretty obvious that the demand growth in the Philippines is very strong. So if you lean a little bit longer than your forecast, you'd probably be okay. And at the very least, you'll be able to show aggressive pricing to your res clients. So yeah, so we did the exact same thing on the desk at Goldman, and basically we were just anticipating client demand. So
yeah, and this is the thought process. You know, we talk a lot about portfolio management and trading desks as a discipline, and a lot of the clients that we talk to just aren't familiar with that that proposition, and are working right now as we speak to actually put those practices and mindset in place within their companies. I think an interesting option is by being slightly long in 2026, because the res is offering these really great prices through 2025 and 2026, they may actually be able to draw new business above plan. And it's kind of convenient to be a little bit long. So there's a lot of optionality in this sellback. It may turn out that the analyst doesn't want to sell back all 20. Maybe they just sell back 18 and keep the other two opportunistically. But this kind of speaks to the power of a financial energy market where this type of agility and nuance is available as a tool. And you can slice 500 megawatts, or in this case, it's a 40 megawatt ask, but you can do plus or minus 2 megawatts and without a lot of remorse or regret. And then be responsive and reactive. If an additional client calls and wants to join, and they want 5 megawatts, it's a quick call to the desk to say, hey, listen, hold back on that last 5 megawatts because we've got a buyer. All right. Here's our third use case. And here this is a solar developer, and I chose to call them Sunburn projects. So Sunburn is going to use CFDs to hedge their revenue forecasts and then use the hedge to raise financing. So the CEO of Sunburn Projects is finalizing the capitalization of a 250 megawatt solar farm in Zambales. And her investors are concerned that the revenue forecast in the out years, so like let's say years 5 through 10, are unreliable. And the CEO is considering the green energy auction as an option, but there's been no announcement when that might happen, and there's a lot of uncertainty on what the price might be. So Sunburn actually goes and sells the forward generation capacity on using CFDs, 100 megawatts of 10-year solar at 4,800 and another 100 megawatts at 4,700. So this is an 80% hedge against the 250 megawatts of planned solar at a blended price of 4,750. Importantly, because these are CFDs and not physical power sale agreements, the Sunburn gets to keep the RECs. And the RECs actually may have monetary value, may be traded as a standalone at some point in the future. It's a contract that we are actually talking to market participants about the opportunity to create a marketplace for RECs. You'll see that in our sandboxes that we've got a placeholder for RECs. And we're speaking with the DOE and the ERC about the prospects of trading RECs to voluntary participants. But back to this use case, the CEO calculates that an improvement in price means that the project economics this solar farm is going to break even 18 months earlier than previous forecasts, and her investors are satisfied with the CFD and accelerate the paperwork. And as a result, Sunburn is able to break ground on the development project 6 months ahead of schedule. Now, even where there's financing secure, the CEO still has 50 megawatts of forward capacity. It's unhedged, which means that she still got latitude and optionality to source an even better agreement for the remaining 50 megawatts, or either through a physical agreement or through a subsequent hedge. And that's something that she can pursue at her discretion. John, any thoughts on this? Are we doing a demo on this one? All right.
Yep,
Sure.
we are. All right. I am going to share again. All right, so we're pulling up the Green Tiger Markets platform again. And again, we have Philippines electricity selected. But this time we've got the Luzon Renewables, which, if you recall, just references 8 a.m. until 4 p.m. And this is the annual cash settled product. So each year has 12 individual settlements. But basically what this product allows you to do is sell the entire year at one clip. So if I look into the trading pyramid and I look for LRA 25, which is Luzon Renewables Annual 2025, and LRA 34, so this is going to be the 2025 through 2034 strip. And I can see, hey, there's somebody bidding in Carlos' example, 4,800 on 100 megawatts, and somebody's bidding 4,700 on 100 megawatts. So I'm going to go ahead and, I'm the developer. I'm acting as a developer here. And I'm saying, you know what, that's a great price. If I can lock it in today, I can go and get my financing. So I'm going to go ahead and execute. And let's see, this order's been placed. And if you remember from our previous example where we were trading the April, we had the 100 megawatts of April at a price of 5,000. We had 200 at 5,100, and then we had 50 megawatts at 5,750. So those all hit the market data screen at the appropriate time. So when I scroll over to my email, I can see, oh, okay, great. Wow, Macro Power is on the other side of this transaction. So Macro Power is really out there being, aggressively showing prices. And so this first ticket, or this first trade confirmation, so I'm logged in as Jamie Diamonds from Electric Power or Sunburn Energy. And the products, we've got the LRA 25 through LRA 34, and each year is posted on the confirmation. And so I sold 100 contracts of each. The price is 4,700, and there's 2,920 hours in each one of the contracts. So that was for the first transaction. And then the second transaction, everything's identical except the price. And this second transaction is the price of 4,800 is the transacted price. And it really is that easy to be able to show your interest to the market or to transact in the market. And so, Carlos, I'll turn it back over to you.
Oh, why, thank you. It's very kind. Let me make sure that I end up on my right page.
I guess while we're waiting for Carlos, are there any questions so far on, we've had some replacement power, we've had hedging some consumption as a res, and then we've also had acting like a solar developer to pre-sell the forward power, or to pre-hedge the forward either supply or demand. Are there any questions specific to those examples, or is there an example that you'd like us to walk you through? And I'll put that out there. And if anybody wants to chat, either put something into the chat, or even message me directly, I'm happy to do that. And Carlos, I'll turn it back over to you.
All right. Looks like it says stop share.
Man, what have you been looking at?
I know I got all these things. Let me find the right tab.
There you go.
It's when I go into slideshow mode, it doesn't actually pop back up on its own. All right, so this is a use case that John and I were talking about that we find fascinating. And it's actually inspired by something that that he was familiar with from a Goldman use case. So we turned it into an electricity scenario. So sunburn projects, which you'll remember from the last use case, secured a CFD hedge for 10 years by selling 10 years at a blended price of $47.50. And construction is about to begin. So now here's the pivot in the story. In the time since Sunburn secured its CFD, several other solar developers have announced plans to deliver daytime electricity. And the 10-year solar contracts are now trading way lower. So now they're at the 2000 to 2400 range, which is, you know, a sharp haircut. It's less than half of what Sunburn paid. What Sunburn, sold at. So anyway, the CEO confers with her advisors and investors and board, and she believes, and the board agrees, that the market starting in the market for daytime power in 2029 is oversupplied. It's their opinion, and it's supported actually by the forward price curve. And so what Sunburn's going to do here is kind of clever, and it kind of speaks to the power of CFDs. They're going to unwind their hedge, and they're going to buy back the 200 megawatt 10-year CFD that they sold at 47.50. They're going to buy it back at 200, realize a gain of 16 billion pesos. That's called crystallize the gain, I guess, on this 10-year solar hedge. And then Sunburn is going to announce that it's going to cancel its solar project. So it's going to take the money and cut loose. The board agrees to take the money that they earned in unwinding their hedge, and they're going to invest that in battery technology. The CEO has been looking at the spread between daytime electricity and evening peak, and then is going to use CFDs to lock in the spread between daytime and evening peak by buying an additional 150 megawatts of 10-year solar and selling 50 megawatts of 10-year base load and locking in a 3,500 peso spread between those contracts per megawatt hour. And then she calculates that if they can transform this daytime into base load, that this battery project is going to earn them $15 billion, not dollars, pesos, as an opportunity for Sunburn. So when I talk about business agility, this is kind of the illustration of what we mean by that, which is like, hey, they were about to break ground in a solar farm, but the pricing signal on the forward curve was so dramatic that rather than build into a declining market, they chose to pivot and then apply the capital, redeploy the capital into an opportunity which was more compelling, and in fact, lock in the economics of that new hypothesis. All right. This is a complex use case, but I think that there's a lot of value in it. I think that it's kind of speaks to the underlying strategies and motivations. John, I know you'll want to give color to this use case and share some of the experiences that you had with some of the power deals that you were working on the US.
Yeah. So, in my time at Goldman, I can think back to an opportunity that we had actually to build some physical infrastructure where the price of crude oil in the US separated from global crude oil by quite a large margin, such that it was, it was roughly $30 a barrel cheaper in the US. And so we were contemplating building a pipeline from Cushing,
Hi guys,
Oklahoma down to the
kamusta? Narinig mo ba doon ako?
Meeting ba yan?
Hindi.
Actually.
yeah, so we built so we were contemplating building a pipeline from Cushing, Oklahoma down to the Gulf Coast. In anticipation of doing that, we put on a hedge where we sold Brent crude oil and we bought WTI at about a $30 difference. And we put on about 50 million barrels of hedges that we used, a market very similar to the CFD market, but a forward hedging market. We made an announcement that we were going to build a pipeline, or at least finance one. And the spread came right in from $30 into about $5. And instead of building the pipeline, we actually just unwound the hedges and said, oh, okay, well, hey, if it's only $5, it's not worth it to us to do it. But because we locked in, before the announcement, we were able to, if the market didn't come in, it was like, okay, hey, we're already hedged, and let's go build the pipe. But it happened to work out that the market came in quite a lot. So that was one example where we were able to basically hedge and then unhedge around the financing of the deal. So I don't know, Ali, if there's others that you can think of, but I think that's probably one of the big ones that we were involved with.
Yeah, I can think of an analogous example with another commodity, silver, where the agreement was, again, this was Goldman, to prepay for, so this was a junior mining company in Australia. So the agreement was to prepay for the silver that they had taken from the mine and sent to the Australian Mint. And by securing a buyer for all of the silver that was being produced by the mine, the company was then able to get financing, or actually, no, the financing was from the prepay, and so was then able to use those funds to build the asset that they needed, as in the mine, and the infrastructure to take the ore to the mint for purification. And so I think if we think about this, taking it in the context of maybe a solar farm, being able to, I know it's slightly different to this unwinding a hedge example, but it's another example of where you can use financial products to sell in the future the actual commodity that you're generating, in order to get yourself financing to build the product that you need to make in order to generate that commodity. And so it works across all asset classes for commodities, whether it be silver that you're getting out of the ground, or electricity that you're generating from the sun. The ability to sell in the future to gain the financing for making the product is useful, and these products help to do that.
So when we talk about market agility and the efficient deployment of capital, like these are the things that we have, that we imagine and that we envision, having certainty on the P&L means that you don't need to hold the capital reserves against the worst case scenario. And that money then can be deployed into growth projects and growth initiatives. Those are the types of things that economies really benefit from, especially in the energy space, and especially in a country like the Philippines, which is long-term short a lot of generation capacity. John, do we want to do a demo for this, or should we?
Yeah, I mean, essentially, I'm just going to go in and and buy the
Buy
same thing
back
getting
the thing that you
sold.
sold in the last demo.
But just at a very attractive price, and there's a massive P&L associated with it. So I think we can skip that for now, just because I see that we're about quarter till, and I wanted to make sure that we had some time for questions. So
All right. Right. Trying to, here we go. Share the right screen. All right. So here's my concluding slide. And the short of it is, CFDs are new, and it can be, for people that aren't familiar with some of these hedging tools, it can be hard to imagine exactly how they can be applied to your specific business context. Between John and Ollie, decades of experience designing and working through these types of products. So we're available to help. Of course, we're really interested in making sure that our clients are familiar with the techniques and the practices. We are really conscious of the fact that the energy sector in the Philippines is transitioning from this physical mindset to a financial mindset. And a lot of what the Learning Academy is about is to help kind of guide and sponsor and explain what that transition is going to entail. So definitely take advantage of the knowledge, and don't hesitate to reach out. So I'll open to the floor. If there are any questions?
Maybe I'll start it rolling by asking John a question.
Okay.
It's not a plant. I just generally came up with this. We've talked quite a bit about companies that have exposure to the physical side of electricity generation or consumption, and how they can use CFDs as a financial tool to hedge their revenues, whilst having this physical element to their business. But John, is it necessary to have a physical element to your business in order to be able to use these products and have it, and act as maybe a res, for example, without actual generation or consumption?
yeah, so that's a great question. The
Thanks.
short answer is no. It's not necessary to have physical consumption or physical generation today to utilize the products that are available on the Green Tiger Markets platform. We actually were just in the last couple of weeks, we've had a conversation with a firm that's thinking of starting a res, an independent res that doesn't have any generation today, but is considering building generation and actually wants to gain a book of business on the sell side before the company builds a generation. So what they are considering doing is buying on the GTM platform so that they can hedge the exposure to the volatility of the Luzon price, and they can offer contracts available to the contestable consumers. And so, they don't have any generation assets. And in fact, they don't have any customers yet. They're in the very early days of starting their res, but they are basically in the process of putting together their registration documents for us. So yeah, so it's a great question. It's not necessary. And that's kind of the beauty of the products of the CFD market, is that we can sort of dislodge the physical and load balancing aspect of the market with the financial hedging aspect of the market. And the idea is that it would new entrants will come in, or existing participants can actually grow and scale their businesses a lot faster because as we saw earlier on some of the examples, the ability to enter or exit a position is literally just a couple of clicks. And as opposed to calling around to all of the market participants, hey, if you need to buy, there's a lot of generators that you need to call to really canvas the market. So the GTM platform has centralized all of that price formation process. So yeah, great question. Are there any other questions out there?
Hi, John. This is
Hello,
Penny.
hey Penny.
Uh, just curious, what are the products that you already have? Do we foresee opening also products that are based on Visayas or Mindanao pricing?
That is a fantastic question. I'm glad you asked it. I was gonna probe Ali or Carlos if nobody else asked it. So in terms of what's available and what's most active on the GTM platform right now, it's Luzon around the clock monthly products. Those are by far the most actively most active markets. We've recently rolled out the annual products. So if you recall, we've got the around the clock, we've got peak, which is 7 a.m. to 11 p.m. on business days. And then we've got the renewable product, 8 a.m. to 4 p.m., 7 days a week. So those are all available in daily, weekly, monthly, and now annual for Luzon. We actually have all of them available for Visayas and Mindanao. There's just, given the fact that the Visayas and Mindanao grids are much smaller. I mean, they're roughly, 20% of the size of the Luzon grid. There's fewer market participants there. However, we did have a client come to us and who was a buyer of Visayas for April through June today. And so we've been contacting, basically the potential offers in the market. And frankly, if there's anybody on the call that's an interested seller in Visayas for April through June, let me know. And perhaps we can match you with the buyer. But yeah, Penny, great question. Those products are already available. We're able to match and settle them, even if we haven't made them live on the platform as of today. And that's mostly to limit the number of products so as not to confuse people. So yeah, great question. Any other questions?
All right. Well, we have 4 minutes left. I'll just close by saying, just to reinforce, we think about these scenarios a lot. We think about what our clients need. And as things come to mind, if there are things you want to trade and you don't know how to trade them, or if you have a situation that you think maybe CFDs are a way to solve that, or if you're naturally short and you want to get long, or if you're long and you want to get short, just don't hesitate to give us a buzz. And we'll be interested and eager to speak with you.